Have you ever wondered how companies decide which big projects to pursue, or how they measure the minimum return a new investment needs to generate to be worthwhile? It is a fundamental question for any business trying to grow strategically and responsibly. The weighted average cost of capital, or WACC, pronounced WACC, is a crucial financial metric representing the average rate of return a company expects to pay to all its different security holders, like bondholders and stockholders, to finance its assets. It essentially gives us a benchmark for the cost of financing a business, acting as the discount rate for future cash flows in valuation models. The reason WACC is so important lies in its reflection of the blended cost of a company's funding sources, primarily debt and equity. Each of these components has its own cost, influenced by market conditions and the company's risk profile. The cost of debt is typically lower because interest payments are often tax-deductible, creating a tax shield. The cost of equity, on the other hand, is generally higher as investors demand a greater return for bearing the equity risk, which is often considered more volatile than debt. To calculate WACC, you must first determine the cost of equity, often using models like the Capital Asset Pricing Model, or CAPM. Then, you calculate the after-tax cost of debt. Finally, you weight these costs by their respective proportions in the company's capital structure, meaning how much of its funding comes from debt versus equity. This creates a single, comprehensive discount rate that captures the riskiness and financing structure of the entire enterprise. Understanding WACC is particularly vital in capital budgeting, where it serves as the hurdle rate for investment projects. A project is typically considered valuable only if its expected return exceeds the company's WACC. This ensures that the project creates value for shareholders and covers the cost of the capital used to fund it. It is also a core component in discounted cash flow valuation, helping investors assess the intrinsic value of a business by discounting its projected future cash flows at this rate. Ultimately, WACC provides a quantitative measure of a company's overall financing expense, allowing management to make informed decisions about project selection and capital structure. For investors, it offers a window into the company's financial health and the inherent riskiness of its operations, serving as a critical input for robust valuation analysis and strategic investment choices.